Is it really possible for the official inflation rate to go down while actual inflation goes up permanently? The answer in this video. Let's begin by taking a look at the Inflation Reduction Act. That's right, your government is going to act in order to bring inflation down. One of the things that I thought was extremely interesting was that the IRS is going to get a lot of money. In fact, they're going to get $80 billion in funding to hire as many as 87,000 additional employees. This increase would more than double the size of the IRS right now. They are going to be bigger than most of the other groups in the US. They're going to be one of the biggest, in fact. One of the biggest departments, the IRS. And do you think that this is actually going to have a positive impact on the underlying, financials of the United States? Of course, we know the answer is no. With the introduction of the IRS and, of course, the Federal Reserve in 1913, it has been a problem ever since. Now, that is a lesson for another day, but I believe that people should start to search what happened in 1913 for some details. Look at this. Credit card debt is soaring. You see, when you have inflation rates that are going up these levels and people are unable to afford the basic essentials, well, then they start to deplete their savings. And when savings go away, then they have to start using debt. Can they get a home equity line of credit? Can they get a personal loan? Things that have lower levels of interest. Well, when that has been exhausted or not possible because of credit issues or any other issue, well, they have to go to the credit cards. And hey, credit cards are easy. You swipe, you tap. It makes life, simple in that regard. But we watch as the total balance of credit cards continues to grow, and that is, actually rising along with interest rates as well. You got to understand, when you're paying 17% interest, it's not going to come down. It's simply not going to come down. It's going to be very difficult to ever pay that off. Recession fears and price pressures haven't tamed Americans' urge to splurge. See, they're going to twist it in such a way, but I'm just giving it to you the way that it's supposed to be. Credit card balances are defying the gravitational pull of stubborn inflation and slower growth. They account for about $890 billion of America's staggering $6 trillion in household debt. A lot of that household debt is, of course, with mortgages. You could see they're just basically saying, hey, they're going out there, they're paying for everything, when it's shopping, maybe it's gasoline, maybe it's food, and so on. But this just shows us what's been happening to the debt aspect, and that's where growth comes from. Growth today is basically running off of fumes, running off of debt. Debt is when we have money like literally created into existence, loaned into existence, and there is a ceiling on how much that can happen, and you get to a point where that has to start falling, and then of course it goes past the mean, and then it reverts. This is the way it happens over and over. It's a cycle. The fact of the matter is that this, by the way, is basically just talking about the Federal Reserve. They create this cycle of up and down and up and down, and they are responsible. Check this out. Look, the fact of the matter is that this gives, talking about the jobs numbers and everything that's been coming out, okay? Gives the Fed additional room to continue to tighten, even if it raises the probability of pushing the economy into a recession. Quote, it's not going to be an easy task to continue to tighten without negative repercussions on the consumer and the economy. And it's already been there. The pace at which they're increasing is significant. Remember, when you're coming off the bottom at 0, it takes a lot to get it up to 2.5. It's not as if, let's say, we are at 2.5 and then we went to 5. That's not as significant as 0 to 2.5. So here we have a situation in which the jobs numbers are coming in strong. The stock market is strong. I mean, everywhere you look, it's strong. But there's just one issue, and that is the Federal Reserve is going to look at all that information and say, well, we have to keep on pace until inflation starts to subside. And at this point, that is definitely not the case. Fed rate hikes, unemployment, and recessions. So we're looking at the unemployment rate in the blue. That's 3.5% as measured by the U3 unemployment rate. If you look at the U6 unemployment rate or any other measure, yes, it will be higher, but the general direction tends to be the same. And you will just see that, yes, we do encounter these periods where it goes down, 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 down. Something happens, a catalyst occurs, and then it flips in the exact opposite direction. Always gets to the very bottom and then shoots right up. It's not as if, it's up and it's down, it's up, it's usually one direction or the other. And now we are heading lower and lower and lower. Right now is one of the lowest it's been in many, many years, 3.5%. At the same time, we got to look at the Fed funds rate and understand interest plays a huge role in this. Huge role. And so what have people been doing with all of these rising costs? Well, in the UK, my friends in the UK, it's interesting to say the least. A campaign group is calling for action against rising energy bills after the price cap is set to increase to a record-breaking amount. Don't Pay UK is urging bill payers to stop paying energy bills if the government doesn't intervene further by October 1st. So essentially what they're saying is, you're going to raise that cap and we can't pay it. Already, supposedly 75,000 people have signed on to this saying, I'm not going to pay, I am committing to this. I heard of a previous instance, I believe it was in the UK. I'm not sure if it's in this article, but essentially saying that there was a previous time, yeah, there you go. In protest, 17 million people refused to pay during, Margaret Thatcher. So you look at that and it's the same kind of thing. You're going to tax people to death. You're going to increase the prices. It's inflation. Maybe it's a political issue. It could be internal. It could be an external thing. It could be so many different things. But in the end, the consumer is only going to take so much. If they're drowning, they're not going to be able to withstand it, and they're going to fight back in one way, shape, or form. That's happening in the UK right now, as you see. Global food commodity prices decline in July. In fact, this is interesting because we're watching food go up and up and up. And while I have warned about what's happening with the oils, that had come down considerably. This is really the one that was, I should say, gone up considerably and now has come down quite a bit as well. It's those oils that are the big one because they require more processing and other factors. This just shows us right here, as you look at the food price index, this came down 8.6% from June, marking the fourth consecutive monthly decline since hitting an all-time high earlier this year. What is interesting about this is that we will see inflation rates, absolutely possible. Inflation rates going down and down and down. Slowly, could come down. We see these numbers. By the end of the year, it's lower than where we are today. In fact, if I just quickly pull this up, let me switch to that. You can see the true inflation, okay, measured by many, many factors, 9.63%. According to true inflation, you can look at shadow stats, whatever, it doesn't matter. I'm just trying to show you that it's absolutely possible, okay? But there's just one problem with all of this. It's that when you go to the store, and let's just say you're buying, I don't know, bag of chips or something. That bag of chips, that company, Hostess or whoever makes the chips, this company, they went from $1 to $1.50 to $2 to $2.50 and so on. And now, are they going to reverse that? Like if inflation rates start to decline, food prices start to decline, oil start to decline, are they going to reduce the actual prices that you pay? Like, please, let me know in the comments. Do you see that? Has that ever happened? We watch the prices every year, over year, over year, over year going up. Now, maybe they go up 2%. Maybe they go up 5%. Maybe it's 50%. But you don't see them go down. That just really doesn't happen. Now, while the commodities and all the electricity for these places and so on, they might go down. The company uses this as a period where they can get a little bit more profit. That's just the way it goes. So this is the key, because you can't have a situation in which companies are going to withstand the period of, high inflation and not try to make that back later down the road. They're going to do whatever they can. It's so important, okay? So that's why I say the official inflation rate absolutely can go down. But the amount you pay for stuff generally doesn't go down. It's just the way it goes. Here you could see the actual chart form for the UN food price index. We did go above and beyond what we saw in previous cycles, and now it has come down quite a bit. Here we have the US pending home sales index as well. So this is yet another one that has declined. And why? We've got inventories piling up, we've got interest rates piling up, and of course that will impact the entire real estate sector along with people that work in it. If you're not already subscribed to the channel, make sure you do so, okay? Because this video, the next video, you're going to have some key intel you're going to want to watch, because I'm covering everything that the Fed does, and you want to stay tuned with that. So definitely hit that subscribe button. Now, there's an issue with US and China. And what is it? Well, you've got Taiwan right now in the middle. And what is so important to understand about Taiwan is that this is where the semiconductors are coming from, the large majority of them. And while you could say we can, change the supply chain, we could do this and that, I get it, yes, but at this time, you've got not only just Taiwan, but one company, TSMC. This is the company that's just so dominant. It is so dominant, and that is really a focal point of the tensions between the US and China today, because they're just supplying semiconductors, not just for the US, not just for China, but the whole world massively. And of course, any disruption to Taiwan is literally going to impact you essentially immediately. Immediately. There are these computer chips in anything and everything. And yet we are so reliant on one country, and even further, one company. So this is a very big concern. So just imagine the price would skyrocket for semiconductors, and the availability, of course, would decline dramatically. So let's keep our eyes on what happens. At this time, it seems like, the biggest issues are kind of behind us, but we'll see. It could escalate in a moment's notice. And then we have this really quickly, wanted to add it in. Turkey agrees to pay for Russian gas with rubles. Yet another country doing this. The US dollar is one that countries are just saying, I don't want to deal with this anymore. I can't. I'm getting sanctioned here. I'm getting restricted there. I've got tariffs on this and that. And they're saying, you know what? If we don't have to use the US dollar, we're just not going to use it. Okay. And there's so many different countries that are involved in this. It's China, it's Russia, the BRICS nations, and so many others. I've covered this before, and I'll cover it in the next video and after that as well. If you appreciate it, simply subscribe to the channel. I'll bring you the best of the best. And that's it. Take care.